quick note before we start with the video, guys. I didn't realize that originally I had put 1 penny for this company, when in reality their annual dividends per share is 4 pennies. So when you guys first see this part of the video, when I go into the calculator, it's not 1 penny, it is 4 pennies. I changed this later in the video. Just full disclosure, and also that the payout ratios is not 1%, it is 4.03% and 4.05% for last year's cash flow and the 5-year average free cash flow. Hi there everybody, and welcome back to another stock analysis video. Today we are going to be analyzing the company Interface, which was actually a company brought up by Rabinsky, where he pretty much just said, can you do tiles? So sorry it's been a little bit since I've gotten to these companies, guys. I think this is the last one that all of you guys commented and requested. If I missed one, I'm terribly sorry. Please leave it in the comment section below if I did miss it. But nonetheless, today we're going to be analyzing Interface, which has to do with carpet tiling, I think. So let's analyze their fundamentals and see if we would like to buy this company at the current share price. So with that said, let's get started with this analysis. Let's start off, guys, with the dividend summary. To my surprise, this company actually does pay out a dividend of 0.3%, which ends up being a penny per share, which is just hilarious, which comes out to be 4 cents in annual payout. Clearly they pay it 4 times a year, that's why it's 4. Payout ratio of 2.86%, which is again really funny because that's really tiny. However, the 5-year CAGR, guys, is at a negative 30.12%. And this surprised me because their dividend growth is also 0 years. And if we actually take a look at their dividend history, we can see that, well, the reason why they actually cut it is because of what happened in 2020. On June 3rd, 2020, they cut it down from 7 cents to 1 penny, which is what they currently have it at right now. So within the past 5 years, they've actually had a fairly good track record of paying out a dividend and increasing it as well. However, as of last year, guys, they did cut it from 7 to 1. That is essentially why their CAGR, it is so bad. However, if we actually take a look at the max, you can see that from 2002 to essentially 2007, they did not pay out a dividend at all. So it's not as reliable when it comes to the entire life of this company to pay out a dividend. But within the past 10 years, they have essentially given out, except for the fact that COVID happened in 2020. And they essentially cut it. So do with that information as you will. Their ex-dividend date passed as of June 2nd. Payout date was June 17th, and they pay their dividends quarterly. Now let's come into the calculator. Ticker symbol of TILE, tile, market cap of $781.4 million with a PE of 12.46. So based off of this PE, in accordance to their earnings, this is telling me that with a current share price of $13.14, it might actually not be a bad buy, guys. However, earnings is only one metric. Let's see other ones as well, especially their cash flow. Let's give all of them a grade and then see how much overall their grade is for each individual metric. And then after that, let's see if this $13.14 is actually worth a price to be paying for this company. Now, as I said, they do pay out a dividend of 1 penny annually, which actually ends up being $590,000 being paid out in dividends every single year. And in regards to their 5-year average free cash flow after this is paid out, they're still left with $57.77 million. And in regards to their last year's free cash flow, they're still left with $58.01 million. As a payout ratio, this comes out to be, guys, 1.01% for both last year's free cash flow and their 5-year average free cash flow. Alrighty, now let's jump over here to some fundamentals, starting of course with the net income of 5 years ago of $53.2 million to 1 year ago of $55.2 million. That is an increase of 4% on the 5-year, and as we can see right here, 2 years ago, because of COVID, they clearly went down to negative $72 million. So perfectly understandable as to why this happened. However, what is fairly not good is that this graph is not consistent at all. So you can see right here from 5 to 4 years ago was a decrease. From 4 to 3, it was a pretty big jump. And then from 3 to 2, because of COVID, you can pretty much ignore this one, went down. And then from 2 to 1, they went up again. The only issue, the reason why I'm saying that this is not that good is because you can see $55.2 million, significantly less than that of 3 years ago of $79.2 million. So not consistent at all. Overall, I'm going to give this, guys, not too low of a grade, but not too good of a grade either. I'm going to go with around a 40% mark. Coming now into the free cash flow, the most important of all the profit metrics, because I always have to say that in every single video, because I can't say say this enough. Every investment is the present value of all future cash flow. Cash flow, it is the most important out of all of them because this is what companies use to essentially operate. Company uses cash flow to pay out a dividend, to buy back shares, pay down their debts, and overall grow the company. Very, very important for this thing to be going up. And as you can see, 5 years ago, it was $72.9 million, essentially $73 million, to 1 year ago of $58.6 million. That is actually a decrease of 20% on the 5-year, and they have a 5-year average free cash flow of $58.36 million. And on top of that, you also have this graph being fairly stagnant as well. So you can see the highest that they ever did was 5 years ago of $72.9 million, and they have still yet to break that point 5 years later. So unfortunately, it's not consistent and it's also not growing either. So I'm going to give this guys a score of around 30%. Now looking at the revenue, we got 5 years ago of $996.4 million to 1 year ago of $1.2 billion. That is an increase of 20.47%. And as you can see right here, it is increasing, though it is kind of not consistently increasing. We did have a nice increase from 5 to 3 years ago, and then they went down because of COVID, perfectly understandable, and then they are slowly starting to come up. So I do foresee this thing to keep going up in the future. However, the fact that it hasn't reached the $1.3 billion that they did 3 years ago is a little bit concerning. But nonetheless, it is still an increase. It looks like it's heading in the right direction. So I'm going to give this guys essentially like a 70%, barely passing C- at best. Now looking at the balance sheet numbers of assets minus liabilities, can this company's assets cover their liabilities? Hopefully, if things really do hit the fan in the economy, hopefully this can actually save them. Obviously, you want the assets to cover their liabilities, and currently they're at $347.3 million in this difference, and I gotta hand it to them. Within the past 5 years, they've been roughly around the same. It has been increasing, but it's been roughly stagnant around like the $330 to $370 million. They did have a dip in this metric 2 years ago because of COVID, but nonetheless, everything else is still pretty good. Average total assets around $1.2 billion. Average liabilities around $895 million. Doing this difference, we get $348.35 million. Overall, I'm actually going to give this guys like a 65%, just because of the fact that it's in the positive, and I'll give them that. But as you can see, it is not consistently increasing as of recently. So unfortunately, I'm gonna have to give it a 65%. Could be a little bit better if this value, the current year, was actually higher than the 1 year ago, which by all means it could be, right? Once this year ends and the value gets fully updated, then this might actually receive a 70% or higher grade from me. But now let's actually see if their cash flow is able to cover their liabilities, because as we saw, their cash flow is pretty stagnant, which is kind of underwhelming. And as you can see right here, if we take the cash flow and subtract the liabilities year over year, we want essentially this thing to be getting closer and closer to zero, ideally positive. But unfortunately, that is not happening. Currently, they're at negative $908 million, which, to their credit, guys, it is a little bit higher than that of 3 and 2 years ago. However, from 5 years ago to today, this is getting deeper and deeper in the red, but it seems like they are bringing it back closer to zero. If we take the average cash flow minus the average liabilities, we get around negative $821.94, essentially $822 million. I will give this guy essentially a grade of like 45%. It is getting further in the negatives, however, they are bringing it slowly back up to zero. Now for the metric that I always dread, especially with small companies and companies that don't pay out the dividend, though this one does pay out the dividend, so I guess only one of those things is true for this one. The shares outstanding. You essentially want this thing, guys, to be going down. I can't stress this enough. If this thing goes up, that is actually really, really bad for you, the investor, because the company's profits is being spread out among more and more people that are buying this company's shares. So if the less shares that there are out there, the more piece of the pie you own of the company. And on top of that, if the company also pays out a dividend, their payout ratio in regards to their cash flow comes down as well, because that is extra dividends that they no longer have to issue anymore because they own the shares themselves. So really, really important for this value to be decreasing. And as you can see, it is decreasing, but there's a little bit of a caveat here, which might be a little bit of an issue in the next coming years. 5 years ago of 59.8 million shares to today, guys, of 59.1 million shares. There's a decrease in the 5 year of only 1.17%. And from the previous year to the current year, this is looking at 2 years ago to 1 year ago, that is an increase of 0.68%. So it is a decrease, however, it is not that big of a decrease. They're not buying this thing back aggressively. However, what really is concerning me here is that you can see, sure, on the 5-year it is decreasing, but if we take a look at the 3-year mark, we can see that they were 58.4 million shares, and ever since then, guys, they have been issuing more and more shares. Will this continue? I don't necessarily know, but they do have precedent that they have kept the shares roughly the same, or that they are increasing it as well as buying back too. So this could go either way. Hopefully they'll continue to buy back shares in the future. But if this thing were to stay up more than 58.4 million shares, then you would definitely have a massive increase on the 5-year. Overall, I'm actually going to give this, well, I don't necessarily know, because it's kind of, I don't know where it's going. That's essentially what's happening here. So I'm gonna go middle of the road at around like a 50%, maybe even 45%, but I think I'm just gonna keep it at 50. But it's very, very weird as to where this might go in the future. And now looking at the cash and equivalents, they currently hold $91.7 million with the average cash of $90.23 million. Now let's do a quick recap before we get to the discounted free cash flow. We got the net income, we gave it a 40%, free cash flow 30%, revenue 70%, assets minus liabilities 65%, cash flow minus liabilities 45%, and shares outstanding 50%, for an overall grade, guys, of 48%. Pretty much in line with my opinion about this company so far, that it's kind of 50-50. I have no idea where this might go into the future. Alright, now let's make some assumptions, low, medium, high, using of course 3 different factors: the revenue growth, the predicted share buyback, and the required rate of return, which I like to keep flat at 10%. Let's come over here, guys, to Seeking Alpha's growth tab, and we can see that the revenue growth forward is 7.68%. The revenue growth year over year has been 16.61%. So let's make some assumptions using that, because those seem fairly probable for the future as well. So for the low assumption, let's say a revenue growth of 7%. For the median assumption, let's go up by 5, let's say 12%. And for the highest assumption, let's say another up by 5 to put it at 17%. So right below the revenue growth forward for the low assumption, right above the revenue growth year over year for the highest assumption. Now for the projected share buyback, this is where it's a little bit tricky because we don't know where it's going. At least I don't know where it's going. So I'm going to say that in the next 4 years that they'll buy back 0% of their shares. For the median assumption, let's say that they'll buy back 1% of their shares. And for the highest assumption, let's say that they'll do 2% of their shares. Now we get some target share prices. However, only one of them kind of work out. So for the target share price, not adjusting for debt, we get $3.36. Median assumption, we got $4.01. And for the high assumption, we got $4.76. Normally, I would tell you guys about the target share prices after debt. However, from what this is telling me is that they have so much more debt than they have cash on hand that clearly this value goes into the negatives, therefore it does not work. So just based off of that, guys, I say only focus on the target share prices, not adjusting for debt. And as you can see, the current share price is $13.14. So ideally you will want this thing to fall by around $9 or so for it to buy at the highest assumption, assuming that it'll grow at 17% and buy back 2% of shares for you to get 10% required rate of return. Now, a lot of you guys are probably saying that's ridiculous. That's a $9 drop. That's absolutely insane. That will never happen. Okay, if you don't believe my assumptions, no problem. Let's double check this with a book value per share analysis as well as a tangible book value per share analysis. This involves 0 assumptions on my end, and it provides almost like a second-hand assumption as to what this company should be worth. So looking at the book value per share, guys, currently they're worth $5.88. 5 years ago, it was $5.52. This is up 7%. And looking at the tangible book value, we get something similar to today of $2.61. 5 years ago, it was $4.37. This is down 40%. And now looking at these valuations, doing the price divided by the book value and the price divided by the tangible book value, this gives us 2.23 points as well as 5.03 points for the book value and the tangible book value, essentially telling me that it is still overvalued in accordance to these. You want these values as closest to 1 as possible or under 1. You can see it is significantly above 1. And in both scenarios, guys, as you can see right here, the book value is telling me that it is expensive, which falls in line with what my discounted free cash flow was saying this whole entire time, that it is still expensive and it should be worth around this kind of target share price. Now, if you guys don't believe me, that's fine. Every investment is the present value of all future cash flow, as I just said, as well as none of this is financial advice. That's why I have this calculator available for free. Anybody can have it. It's in my calculators playlist. You guys can go on there. There are videos called Discounted Free Cash Flow Update. You go into the link in the description, you come up here, go to File, make a copy, and you play around with these calculators by yourself. I have this one, the book value one that you saw, a reevaluation one, and a dividend tracking sheet for everybody to have. So please do not follow my assumptions. I am not telling anybody what to buy. All I'm saying is this is the process that I use to evaluate whether or not to buy a stock for starters, as well as what price to buy a stock at. That is essentially why I am giving this out for free. All I'm asking for in return is just help me grow my channel, like, subscribe, comment. We're up to 838 subscribers. Thank you all so much for everybody who have subscribed. And I'm looking forward to the 1,000 subscribers. I have a video plan in the works that everybody should hopefully like for that subscriber special. I might even make it a two-parter also. But yeah, thank you all so much for everybody who has subscribed. Again, just help me grow my channel. Like, subscribe, comment, really does help. And now let's analyze these dividends, because with a 4 cent per share annually, we don't really expect a lot of this company, but let's just amuse this for 1 second, right? So let's say you make the average monthly income of $5,725 and you put in 1 month's income into this company at the current share price, which in accordance to the book value and discounted free cash flow, it is overpriced. This buys you 435.71 shares and the current annual dividends per share of 4 cents. This gets you guys $17.43, quarterly dividends of $4.36, and a monthly dividend of $1.45. Yeah, guys, there are better ones out there, especially when it comes to a dividend, right? Unfortunately, this one doesn't have a CAGR that's amazing that you would say, okay, $17 annually, but look at their CAGR though. Oh my God, right? It's in the negative 30%. So overall, when it comes to dividend, this is not that good of a play. Overall, Tile, I gotta say, it's kind of mediocre, right? I really wish that I could say it's amazing. I'm not saying it's not, but there are just some things that are good, there's some things that are bad, and it's overall just average. I don't necessarily know where to put it. Obviously, the weighted grade, we got 48%, so it could go either way, right? It's literally 50-50. It's not good, and it could go bad, and it could go good. I don't necessarily know where this is going. In my personal opinion, I would skip this for now, wait until we get a couple more years and analyze them again, just to see where they're actually at. And then if their numbers actually end up being really, really good, then at that point, make the analysis, make sure that it's not too overvalued like it currently is right now, in accordance to discounted free cash flow and book value, and then make your decision after that. But that's just my personal opinion. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help out with the algorithm on YouTube, as I said. You guys can follow me on my new tech sites, link in the description below. So with that said, peace out, and I will see you all in the next stock analysis of video.